Thank you for joining. My name is Martin A. Smith. I'm the president at Wealthcare Financial Group. Wealthcare is a wealth management, retirement planning, and investment advisory firm. We're located in Peachtree City, Georgia, Washington, D.C., as well as in Maryland. And today we're continuing with our series, Pathways to Your Retirement. And in keeping with that theme, what we're discussing today is your employer-sponsored retirement savings plan. Now, we came up with the idea of pathways because, well, there's really no one right path to achieve retirement. Some people want to start with education first, such as with our webinars. Others may start with receiving a complimentary financial plan first. Some may just want to jump right into investing, and we offer a digital advice and digital investment advisory platform, also known as a robo-advisor in our industry. And some just want to schedule an appointment or just ask a few questions. We're not going to sort of try to steer you down one path. We're going to say, look, you make the choice that's best for you. We're offering the pathways. Just come as you will, and let us see if we could be of assistance. So for those of you who prefer the education path, we offer these webinars. And today's webinar is focused on your employer-sponsored retirement savings plan. Let's get started. So retirement is a new beginning. And when you think about what you want life to look like in retirement, and I always tell clients, paint a portrait in your mind of what that looks like. And then let's back into that from the perspective of where we are today, whether you're retired already or preparing for retirement or maybe 30 years from retirement. And let's think about what that lifestyle costs. Let's project out as best we can what your expenses may be in retirement so that we can make certain that you are saving and contributing as much as you can each month, each year to your employer-sponsored retirement savings plans so that you can achieve that life in the future. Today's retirement can last longer than ever before. Now, that's a good thing, but that also means today's retirement costs more potentially than it did in the past. Your retirement could last 10, 15, 20, 25 years or longer. The question is, when you retire, how much will you need? Do you have enough set aside to provide for 70 to 100% of your final year's salary each year during retirement? Think about that. If you earn $100,000 a year today, and with the rising costs of inflation, you're going to need potentially 70 to 100% of your current salary the day you retire. And you may need that from 10 years to 25 years or longer, depending on how long you live. So taking a look at 70% of $75,000 in this example, it's $52,500 a year. And if you're earning $75,000, 90% is $67,500 per year. Now, the reason for that is obvious. Life gets more expensive as we get older and as time goes. I recall, the last 2 years of President Obama's presidency, gas prices were as low as $1.99 a gallon. It's pretty sweet. Today, gas prices are substantially higher. So again, inflation matters. If you think about the cost of milk, a haircut, shoes, a new car today, tomorrow, those same goods and services are going to be substantially more. So how much does it take to provide for 70% of income for 25 years? If you have 10 years, 20 or 30 years until retirement, if you make $60,000, for 10 years, $1.2 million, 20 years, $1.6, and 30 years, more than $2.2 million. And by the way, let me just go back and underscore. We're talking about in today's dollars, okay? In today's dollars, which you must have in a lump sum if you retire today and you need this income for throughout your retirement life expectancy. Now, some people will say, well, won't Social Security provide what I need? Social Security may help as one source of income. However, it's intended to be a safety net, but because we have fewer workers, American workers contributing to the Social Security fund, it may not be there in 30 years. In fact, by the year 2034, it's projected that we'll have 25% fewer American workers contributing to Social Security. So I really wouldn't bank on Social Security. If it's there, great icing on the cake. We have to build the cake or bake the cake, and that's going to be your savings in your retirement plan. So why start now? Because compounding is important. You want to start saving for retirement as soon as you can. Now, this is a hypothetical illustration. Let me get my pointer out. This hypothetical example shows the result of investing $120 in a retirement savings plan every other week. It assumes a 7% annual rate of return, which of course cannot be guaranteed. And when you think about this, we're looking at $120 every other week, $240 a month. Over 10 years, your contributions were $31,200. Your earnings is almost half your contributions, $13,900. Over 20 years, your contributions are $62,400 and your earnings are greater than your contributions, $73,000. Again, assuming a 7% annual rate of return. In 30 years, you've contributed a little bit more than $93,000. However, because of compounding, if you started 30 years ago, you're at $224,000. So compounding is your friend. It does work on your behalf if you start early. The benefit of participating in your retirement savings plan, and this is where you've got to be disciplined. This is where you have to think about, again, the life you want to live in retirement, because there's a price tag attached to that life. Why save through your retirement savings plan? One, it's convenient. The funds come right out of your paycheck before you even see it. It's going to go in your 401k. It's automatic. It's convenient. Second, there are tax advantages. We're talking pre-tax dollars that you're setting aside and contributing in the market through your 401k that's going to compound hopefully and grow for you. And then you have investment choice. Now, I will say this. Some 401k plans offer a myriad of investments, meaning they may have some what we call target date funds or life cycle funds. These are those pre-built model portfolios that are named by a year in the future, typically 10 to 30 years out in the future. So it may be called the 2060 fund or the 2030 fund. What that means is that the fund takes into account that you may retire in 2030, 2040, 2050, 2060. And the fund is supposed to change its allocation from a risk perspective over the course of your contributions in that fund. So it may begin conservative and slowly it'll usually begin aggressive and then slowly modify itself to be more conservative automatically. So it sort of takes away from you the responsibility of having to rebalance and reallocate your investment choices and your dollars based on what's happening in the economy and the market. Now, is that a bad thing? Not really. Is it a great thing? Not really. Here's why. If that were true, that you can just start investing in a portfolio that's managed for you, and all you have to do is contribute to it, and it starts out aggressive and then it slowly becomes more conservative. Let's say a person had that kind of fund and now they're in the year 2007. It's December. They've rung the bell and they've retired. Now we're talking, it's April 2008. What happened in 2008? The Great Recession. So your best efforts to save and contribute towards your retirement, now you're looking at a 20, 30, 40% loss if you rolled the money over or if you left it there, and if you didn't change the allocation properly. So I'm a fan of and a supporter of not just the target date or life cycle funds, but having individual investment choices in your portfolio, such as mutual funds, bond funds, exchange traded funds. And for those who are self-employed, you may qualify for what we call a solo K plan or the individual K plan. And those plans, you can make a contribution as an employee of your own business. of $19,500 a year. The business can contribute an additional 25% of its profits on your behalf to the plan. And if you're 50 and older, you have a catch-up contribution of another $6,500. That is substantial. It's well over $50,000 a year that can be contributed on your behalf. You, in a solo K plan, can make that contribution until December 31st of the present year. However, the business can make its contribution on your behalf as late as April 15th of the following year. So you can look at what your profits were for the previous year and say, okay, I want to contribute this much of my profits towards my own retirement plan. And if you need funds, you can borrow from up to 50% of your retirement assets as long as you pay yourself back, typically over a 5-year period. You may be able to modify that and adjust it to longer than 5 years, but generally it's 5 years. So I see a lot of people that are in consulting or in sales or private practice and law, and they've saved in their 401k for a number of years, and now they're going to start their own business. And they need startup capital and don't want to go borrow money from the bank or don't want to use a bunch of credit cards. So some people, this isn't for everyone, but some will roll their 401k into a solo K or individual K plan, same thing, both names, and then they'll borrow from up to 50% of the assets and use some of those funds for their business needs and then pay themselves back over a schedule on a monthly basis, quarterly or annual basis. So that's not a bad way to fund a startup if you have previously saved in a 401k, and you can roll IRA assets into a solo K or individual K plan as well. So we discussed some of the ways and the conveniences of saving through your retirement plan. Let's look at why reason number one, contributing is convenient. Because of automatic payroll deduction. This is key. It comes out before you can touch it. You pay yourself first. And what you don't see, you probably won't spend. And getting money out of a 401k isn't necessarily that easy unless you meet the right requirements to do so. So you're probably not going to spend it once it's there. Reason number two, your plan offers tax benefits. Potential tax advantages both now and in the future depending on the type of plan that you have. So let's take a look. If you're employee one versus employee two, and your biweekly pay is $2,000, and you're contributing to the plan as employee one, you're not contributing to the plan, so you have zero contribution. Your taxable pay is $2,000. Sorry for that. Your taxable pay is $2,000. And your taxes paid are $440. Employee two contributes $120 pre-tax. His or her taxable pay is $1,880, and taxes paid is $414. So amount invested, $120, immediate savings, $26. So there's one reason why this example is good and it's pre-tax contributions, and it works in your favor. Tax benefit, tax-free withdrawals. Now, of course, tax-free withdrawals are with a Roth IRA or Roth account, but a Roth account is going to be post-tax dollars, but still not a bad option. There's no upfront tax benefit. Contributions are made in after-tax dollars in Roth, and qualified withdrawals of earnings are tax-free. Tax-deferred growth. No annual tax filing. Who wants to file their taxes every year and have to do more filing because of how they're saving or investing? More of your earnings go to work for you, and possible tax penalties if you're pulling money out of a plan sooner than what you should. Reason number three, investment choice. Now, 401k plan offers a mix of various investments. It allows you to put together a portfolio that is right for you. So you can choose, in some cases, from the choices that you're given by your employer, which investment is most suitable for you based on your risk tolerance. My recommendation is to meet with the advisor, who is also what we call the advisor of record for your retirement plan, and that person should help you with making the choices that are suitable for you for your 401k. If you feel like you need that support, work with a professional as much as you can. You're paying for it anyway in your 401k and the expense ratio. The advisor is getting paid from that plan, so make frequent use of your plan advisor. If your plan advisor offers a free financial plan for employees, take advantage of it. A lot of employees are not aware that they may be able to receive some free financial planning advice and financial plans from their financial advisor, and so they're probably not taking advantage of it. In our firm, we do offer a complimentary financial plan. In fact, option number 3, the third option in the first landing page you saw under Choose Your Pathway for Retirement, you saw that we discussed there. Here's a link where you can click on and receive a free financial plan. So that will save you hundreds, if not thousands of dollars per year. Take advantage of it. Choosing investments for your retirement savings strategy. So let's talk about really what this is about in terms of diversification. You want to be careful because the lineup of choices in your 401k plan, and this is really important for human resource directors and HR managers and CFOs to really keep an eye on. Make sure the choices in your plan are truly diverse. You can have a bunch of different fund choices in name, but then when you peel back the onion, you find that these mutual funds are predominantly invested in the same asset class. So what good is it to have, diversification? You can see the different colors in this, in these Post-it notes here, right? What's the point of having diversification if they have the exact same thing written on them? What's the point of having a diverse portfolio if they're all buying the same stocks, and then your portfolio moves in the same direction? It's called positive correlation. You're defeating the purpose. So you really want to make certain that you're choosing the right investments based on what we call in our firm asset class diversification. So investments typically fit into one of 3 asset classes: stocks, higher risk, higher potential, and higher reward. Now, with respect to stocks, when I say asset class, what I mean is small cap, mid cap, large cap, real estate, bonds, international, and commodities. Now, what is the cap referred to in the name small, mid, or large cap? Cap is capitalization. It is basically the size of the corporation or the stock that's in your portfolio, your 401k. And we arrive at this size by multiplying the price per share by the number of shares outstanding. And that number gives us the total size or the capitalization of that company. So a small cap stock is going to be about $2 billion, mid cap about 5, large cap about $10 billion. And then you have bonds, various types of bonds. You have agency bonds, government bonds, corporate bonds. You have treasury bonds, those are government. You have CDs, which are cash, and what we call those cash equivalents. So you have bonds and then you have cash. And those are the asset classes across the board. And you should have probably some of all of them in your portfolio. Depending on your risk tolerance will determine what percentage is invested in each category. So about mutual funds. They bring together the money of many different investors, hence the word mutual. And they hold a mix of individual stocks, bonds, and or cash. And they are supposedly automatically diversified. Now, let me say this because it is not something that you're going to hear from your fund provider in most cases. There's a thing called style drift, A fund manager, usually they're seeking to provide exceptional returns for their investors, and whatever their relative benchmark is, they want to surpass that benchmark. So if it's the S&P 500 as their benchmark, and if it's a growth fund, a large cap growth fund, they want to perform better than the S&P 500, right? Otherwise, why invest in a mutual fund? Just go buy the index. But if it's a small cap fund like the Russell 2000 growth small cap or the S&P 600 growth small cap, they want to outperform the Russell 2000 index or the S&P 600 index. Now, let's say we're in a year when the mid-cap index, which is the S&P 400. Let's say we're in a year where the mid-cap index on the value side isn't doing so great. Let's say the mid-cap index on the growth side is doing a little bit better than value. The fund is called Mid-Cap Value Fund, for example. And so what tends to happen is that fund manager has to keep an eye on that benchmark because he or she wants to outperform it. And if it just happens to be a tough year for that benchmark, for that asset class, that industry, or whatever, then there's a temptation to do what we call style drift, meaning they start buying other equities or stocks that may not be represented in their unique asset class, i.e. mid-cap value. Maybe they start buying some large cap value, some small cap value, or some mid-cap growth so that they can take advantage of the potential positive performance that may be impacting those other indices, just not the one that they're supposed to be focused on. And so in a sense, it's like cheating. They're still getting you good returns and you're happy in this example, hypothetically speaking, but they're not being true to what they're supposed to be doing as a mid-cap value manager in most cases. So what we tend to say is, in our firm, is that we want to find a pure play fund manager or fund or a pure play index, meaning if it's mid-cap, it's mid-cap all the way through on the value or growth side, or at least no less than about 70% represented in that one asset class, and we give them some leeway to invest 30% elsewhere. And that's important because we want to make certain that you have diversification, that you're not diversified in name only, and that your portfolio is not, if it's a small cap fund, it's not operating like a large cap fund or something. So we want to choose investments based on their true objective. Some examples of fund objectives, and I sort of gave it to you already, but here we go. Typical objective is growth. Description: growth of investment dollars over time can be more or less aggressive. Invest mainly in stocks, and the risk level tends to be higher. Often long-term average returns can carry a risk of loss. Now, income provides income stream over time, mainly comprised in bonds. Now, there may be some preferred stocks in there as well, and generally fall in the middle of the risk-return spectrum. So they're sort of in the middle. Capital preservation seeks to protect investment dollars, and they invest in cash investments and low-risk bonds. We're talking about high credit quality bonds, not low bonds, or not what we consider to be high-risk bonds or junk bonds, high credit quality bonds. And the risk level is most conservative, and it tends to offer the lower return. So you have to balance risk and reward depending on the type of investor you may be. Choosing investment asset allocation. This is important. I said a little bit about it earlier, but want to know what your savings goal is. What's your time horizon? What's your risk tolerance? And then that's going to play into your investment risk as a whole. So how you divide your investment dollars among the three asset classes is really important. If you're going to be more so, and let's go back, aggressive, then you're going to probably have more of your dollars here. If you're going to be more conservative, you're probably going to have more of your dollars here. It doesn't mean that you're going to totally skip growth or skip income. You're just going to tilt and lean more in this direction and have less exposure in these other two. So to help you decide on what's important to you with respect to your risk tolerance, that's part of the work we do in our firm and assisting you with your financial plan. It's not just looking at your budgeting and your expenses and your debts and your retirement goals, but we look at specifically your investments, your 401k, what choices have you made, your IRA. We look at insurance. We look at annuities. We also have in this plan, which ours, as I stated earlier, is interactive. It's online. We are able, through our financial planning tool, to integrate and incorporate your savings, your checking, all of your investments, whether they're inside of your employer-sponsored retirement plan or held in your brokerage account. It's an account aggregation tool, so it gives you the real-time updates as it tracks the value of every investment you have, including your cash, and That's expressed through the financial plan, and there's also an estate planning module. So we're helping you decide on a lot of important things in life, not just how you're invested. So in summary, retirement has changed. It's longer than before. And it's also been said that Americans age 65 and older, 7 and 10 of those Americans are going to need some sort of long-term care assistance. We're talking about long-term care insurance. 7 and 10 Americans 65 years or older. The average cost for a couple in today's dollars is $280,000. We're talking more than $82,000 per year for those who are living long and that may need medical attention of some sort in their retirement years. Most people will need a large nest egg to live comfortably in retirement. Think about this also, because I think this is it's a real touchy issue for some. Now, I grew up in Northern California, which is probably one of the most expensive places to just buy a starter home, if you will, in the country. When I left California in 1988, our home was about $85,000. And it was probably the lowest income community, if you will, in the Bay Area. And about a mile from Palo Alto, sandwiched in between Menlo Park, Palo Alto, and Mountain View. Today, that same house is valued at about $1.1 million. So if you take the lowest income sort of community and look at the average house in that community, you're going to spend today about $1 million for the average home. We're talking 3 bedrooms, less than 1,800 square feet. Now, when the house was originally built, there was only 2 bedrooms. My mother, thankfully, she added on a bedroom and a bathroom, made it a 3-bedroom house. So think about this. If you are living in a state like California and it's expensive everywhere around you, I mean, if I step outside of the neighborhood I grew up in to buy the same house in Palo Alto, you can add another $1 million to that initial base price. So if it takes $1.5 million to $2,500,000 to buy a starter home, and you want to live comfortably in retirement, where are you going to retire to? Your biggest asset's probably going to be your house. And I'm bringing this up to say that for some of you who are in other states, or if you're in this state of Georgia or wherever, and you've got a lot of equity in your home, and you want to think about your retirement life and how you want to express that life, you may consider tapping into that equity, selling the home, downsizing, adding those funds to your future retirement income so that you can live the retirement life that you really want or need. And just view Social Security as icing on the cake. It's not the cake. The cake is what you bake over the number of years of your working life and hopefully have saved consistently in your 401k and your IRA or Roth IRA. Remember, compounding and time can work for you. As an investor, I always say that it's about time in the market, not timing the market. Time in the market. Leave timing to the professionals. Your retirement savings plan can become an important element in your planning because it's convenient. There are tax advantages and you have investment choices. And the 3 key factors contribute to your overall asset allocation decision. Okay, forgive me. I thought there was another slide there, but yeah, those are the 3 key factors to consider in your overall asset allocation decision. The timing is important, the convenience, the tax advantages, and also I would just reiterate, asset class diversification is key. There's nothing worse than thinking you're diversified. We enter a recession and your supposedly diversified portfolio it has as much down capture risk falling in the same direction as the S&P Dow Nasdaq. You want to make certain that your asset class is sound and that it is accurate. Sit down with your financial advisor, give us a call. We're happy to look at your portfolio and prepare a complimentary portfolio review with a comparative investment analysis on your behalf. So if you have not enrolled in your 401k plan, please do so today. Thank you for attending this webinar. And again, my name is Martin A. Smith. I'm your host. I represent Wealthcare Financial Group. We are a wealth management, retirement planning, and investment advisory firm. If you want to contact us, you can call me at this number here or visit our website, which I encourage you to do, and or send me an email. Happy to be of assistance. Thank you very much. You have a blessed day. Take care.